I'd like to introduce our very special guest, Sander Gerber. Sander is the Chief Executive Officer and Chief Investment Officer of Hudson Bay Capital, which is a global investment management firm. He has over 30 years of experience investing across a broad range of strategies and successfully achieving high-quality risk-adjusted returns throughout multiple market cycles. Sander is also known for having developed the Gerber statistic, which measures the co-movement of financial assets, enabling early detection of concentration risks within an absolute return portfolio. Markowitz, who's the Nobel Prize-winning economist and the father of modern portfolio theory, the Gerber statistic was employed to optimize the modern portfolio construct. Sander is also the chief designer of his firm's Deal CodeNet framework, which is a scalable and repeatable portfolio management system that provides granular control seeking to minimize loss, maximize return, and optimize the judgment skills of his investment professionals. Sander's prior experiences prior to Hudson Bay include consulting at Bain & Company, working an equity options market maker at the American Stock Exchange, founding Gerber Asset Management, and of course, then co-founding Hudson Bay Capital. Sander is a member of the Council on Foreign Relations and the Economic Club of New York. He's a fellow and board member of the Jerusalem Center of Public Affairs, which is an independent research institute specializing in public diplomacy and foreign policy. He also serves as a member of USAID's Partnership for Peace Advisory Board, which provides information and advice to USAID and other U.S. government agencies to promote economic cooperation, peace-building programs, dialogue, and reconciliation between Israelis and Palestinians. Sander was previously a member of the Director of National Intelligence's Senior Advisory Group, which provides the Director of National Intelligence with informed external perspectives regarding policy, best practices, industry best practices, technology breakthroughs, and solutions for relevant and current intelligent issues. Graduated from the University of Pennsylvania in both finance at Wharton and humanistic philosophy at the College of Art and Sciences. Ladies and gentlemen, it gives me great pleasure and honor to welcome Sander Gerber. Sander, thank you so much for joining us.
Pleasure. Thanks, Mo. That was quite a lengthy intro. Much appreciated. And it's a pleasure to join your illustrious lunch speaker tour.
Yeah, well, we're delighted to have you. And so maybe, I guess the best place to start is at the beginning. Could you maybe share a little bit about your background, your upbringing, where you hail from, maybe even sharing some of your more formative or foundational experiences in that?
Well, it sounds like out of the Sound of Music, start from the very beginning. I started out in business. I started out as a floor trader. And I had clerked on the Philadelphia exchange floor options during college. I liked it. I liked the thrill, maybe even the noise, the pandemonium of the exchange. But my parents sent me to a fancy school and had to take a home equity line out to send me there. So I thought that me to become a mere floor trader probably was not the right thing to do. So I went to Bain & Company for 2 years, a year in Boston, and then I helped open the office in Toronto, actually. We were on Cumberland, right above the Movenpick by the Four Seasons flagship.
Sure.
But you know, consulting for me was boring, and so I went back to the floor. I went to the American Stock Exchange floor. Someone gave me $50,000 in credit. I traded, kept half the money. That was really the start.
As you just, even before we get into the trading side of the equation, and maybe even dabbling a little bit in Bain, just when you think back about your childhood or early role models and mentors, any of them that sort of shaped who you've become, your worldview today, maybe even books or philosophies that you credit?
Well, I'm from Ann Arbor, Michigan, and it's very much an academic town. And so I was always thrilled with acquisition of knowledge. I think that's why I majored in philosophy in college. I can't say as a child that I had role models growing up, but I have had mentors along the way that have been helpful to guide me. There were basically friends who took an interest in me and guided me. But you know, I'm from a small Midwest town, And people there were not really interested in making money. The financial world was, baffling. I remember when I saw the movie Wall Street for the first time, it was like a completely different world that was totally unfamiliar to me. And so, the people that I grew up with were more interested in scholarship. And so when I went to college, I started out at the Wharton School because I was good at math. And math was my strong point. I found out later that I'm very dyslexic. And because I'm very dyslexic, maybe that's why I had a hard time with reading and writing. But then I decided that I wanted to get more of a broader based education. And so that's when I added philosophy as a degree. And I had to spend a lot more time on my philosophy. But looking back, I think that I've gained a lot more from the study of philosophy than I did from the study of finance, strangely enough.
And how did, when you left university, you mentioned that you went to Bain, and obviously you alluded to the fact that you got bored with consulting. But was there something about that experience that has helped you in either founding Gerber Asset Management or Hudson Bay, or maybe even Amex, that you wouldn't have achieved without that experience at Bain?
Yeah, I was there only 2 years. And when I was there, I didn't think I was getting that much out of it. It turned out I got a lot. I mean, what I got a lot was we would parachute into organizations and identify how the organization was not functioning properly from a people perspective often. Like people, well-meaning people just couldn't collaborate efficiently. And things were being dropped and things would go off the rails. And so it was that experience of seeing how collective groups of well-meaning people can still screw up, which helped me in terms of the formation of everything at first at Gerber Asset Management and then at Hudson Bay, where I understood that I needed to create. See, I was a floor trader, and the money I earned, I just took the money off floor and started hiring people to invest it. And so now I have multiple risk takers using my money. I understood that I needed to scale my risk profile over multiple risk takers. And how do you scale a risk profile? It's a difficult thing to do because a risk profile, the upside, the downside. And so what I did was I created the deal code system. And that really came out of my understanding that people need clarity in order to be able to work effectively together. They need clarity with metrics. They need to understand the big picture. That big picture needs to be effectively communicated. You need then to reinforce that big picture. And this has really guided me. So truthfully, the experience at Bain was very formative for the rest of my career, even though it was only 2 years. And even though at the time, I didn't think I was gaining that much out of it.
Yeah. And then so you start Gerber Asset Management. I mean, you're leaving trading. It sounds like Gerber Asset Management was a really just a kind of your own family office extension, so to speak.
Yes, I wouldn't say I left trading. I left the floor trading. So on the floor, you stand and you yell at people. Right. And I was a market maker in options. So I wore a colored jacket. I'd yell at people. It was very physical. You had to be aware of multiple conversations, multiple brokers. You had to be able to watch the screens, keep track of your positions. It required really a heightened sense of awareness. And I had a talent for it. For some reason, I have a God-given talent that I was able to see. I was able to see music when other people just, were engulfed in the noise. But, it wasn't the place, it was all the people my mother told me to avoid were there. So, people would, and it was a good transition where you could see people can be very nice to your face and try to stab you in the back. And that's Wall Street, and in fact, that's the unfortunate aspects of the business world, is that you have to be aware that people can look nice, but actually try to take advantage of you. So
maybe if you could just elaborate, because again, you clearly had this talent. You're able to sort of hear this music that other people didn't hear to the same, at least same keys, so to speak. How did you transfer that to other members of your team? And what strategies were you pursuing as you left the floor and started Gerber Asset Management?
Right, exactly. So I took the money because by standing on the floor, there were seats, but you aren't really sitting, you're actually standing the whole day. So I left the floor and I understood that most people fail when they leave the floor, because on the floor, you're buying on the bid and you're selling in the offer. And that's a great advantage. And when you leave the floor, now you have to take the offer and hit the bid. So you lose that advantage of the spread between the bid and the offer. So you need to think more strategically off floor. And so the first thing I found was phase 3 FDA announcements, where the stock will either be made or broken based upon an FDA approval. And I would put option overlays on that. And then as that was successful, I would move into other strategies. So I moved into option overlays on risk arbitrage. I moved into warrant trading, stock lending transactions, the actual risk arbitrage itself, convertibles. And as I added these strategies, I would hire people to run those strategies. But I needed to make sure that they, again, there's no outside investors. So from 95 till 05, and no outside investors, eventually had 15 people just trading my own capital. My colleagues co-invested towards the end. And by creating the deal code system, we would identify each trade, each investment position, which, by the way, was always in an absolute return context, because I needed to make money in all market environments. I needed to be able to support the family. My wife won't leave Manhattan. We're blessed with a very large family. I needed to make sure my colleagues felt confident that they would be paid at the end of the year. So I needed a very disciplined portfolio construction methodology that I could transmit to the members of our team so they could understand what we're doing, that would give us accountability and power us to make money in all market environments. So that was the genesis of the deal code system in 1998, which we've always improved upon. And then later came the Gerber statistic and the work. And so really we've been utilizing the same basic construct since 1998, even though the hedge fund started in 06.
So I'm going to come back to the deal code system in a minute or two, but just the contrast. At the time you're running a 15-person, what's ostensibly a family office, investing your own balance sheet, your own capital, and now you're running a large multi-strategy hedge fund that's kind of globally recognized. How would you compare and contrast these two experiences?
Well, frankly, running the family office was much harder, much harder.
Why is that?
Because we didn't have the same resources. Now I have teams of people in all areas that are very highly competent. Because we have a management fee income, we're now running a business. Before, when it was the family office, it was a trading account. We had to make sure we were making money every single day, which we still do, but it didn't give us the luxury to hire an infrastructure in the same way. So it was really just like trading teams. We had a CFO, but it was really focused on just trading teams that were all eat what you kill. And that was a trading account. And a friend of mine actually wanted to invest in 05. And I said, we don't have any investors. And he says, Sander, you're running a trading account, not a business. And I thought about it. And I said, you know what? You're right. I'm running a trading account, not a business. So I said, I should run a business. So with my partner, youve, we started Hudson Bay. And I don't want anyone to think that it's super easy running a $20 billion hedge fund, but it's a lot easier than just running the family office.
Sure. And so when you were thinking about launching Hudson Bay, obviously, besides the scale and the opportunities that created for you, in what other ways did you have to change directions? And what were some of the early principles that you wanted to put in place when you co-founded Hudson Bay that are still really guiding the firm today?
Well, again, the transition actually was very smooth because our portfolio construction, the way we build the portfolio remained the same. So that was very smooth. The big difference of moving from a proprietary trading account into an asset management business is that you need to build the infrastructure so that you can provide the highest fiduciary standard of duty to your customers. When it's just our own money, proprietary money, we didn't have to strike a monthly NAV. We didn't have to be super concerned that the marks were all accurate all the time. When you're running outside money, then you have to we produce a weekly NAV. The monthly is struck by the administrator. There's a whole other infrastructure which we didn't have. So we really started very much on the investing side, and the transition was to build the business side of it. And that's a challenge for a lot of people because oftentimes people have perhaps the business ability, but they don't have the investing talent, or they have the investing talent, but they can't build an organization around that. And we were fortunate to be able to do both.
And when you did both, and I guess that also harkens back to some of your Bain days and some of the skills that you've picked up there, so I two questions. One is, what were some of the things that distinguished back then and distinguish Hudson Bay today from either other hedge funds or other multi-strategy funds? That's question number one. And number two is, how have you, how do you think differently about the culture that you're building or the team that you're building different than perhaps others on Wall Street might? Because it sounds like there are some nuances there.
So we come from, as you put it, a family office, really a trading account where you have to make money every day. And you can't risk being down at the end of the year using our own money. That's very different than your typical multi-strat, which came from a bank prop desk, which is borrowing low-cost treasury capital from the bank and trying to deploy it for a higher rate. Those firms generally use a lot of leverage. And they use the leverage because they were comfortable with borrowing from the bank treasury because the bank obviously wants them to succeed.
Yeah.
From our perspective, we are a customer of the bank. The bank could shut us down anytime. We've got all kinds of margin lockup agreements and whatnot. There's always things that could happen. As an example, in 2008, when a lot of firms had trouble, we don't run a lot of leverage. And that in and of itself creates a very different portfolio construct. Another aspect, because we're so disciplined, because of coming out of the family office, that we want to make money all the time, we don't trust the models that people have come to rely on, the factor models, the various VAR-based methodologies that ultimately relate to correlation regression analyses, which are all fictions. They're mathematical fictions that try to describe a reality, but markets don't follow straight lines, best fits that a regression does. So we came up with our own risk management infrastructure, which is part and parcel with the deal code process, which in large part is based upon hedging each idea on its own. So other firms will put a big soup of ideas together and have like an overlay hedge. And that overlay hedge is going to be dependent upon various mathematical readings. The problem is that those things are not stable. And when you have a big soup and you put the overlay hedge, it's very hard to ascertain when markets move abruptly, what's working, what's not working. Mm-hmm. Now, because we're hedging each idea on its own, when there's a market disruption, like in 2008, like in March of 20 with COVID, we can see exactly what's working and what's not working. And this has been really a key to enabling us to power through. Now, very few firms are so precise to hedge on the position level. And friends of mine who used to run large hedge funds would say, Sander, if you hedge on the position level, you're losing any alpha because you're hedging each position. But that's to me, that's the whole point, that we should be able, if we're generating an alpha, we should be able to hedge the position and still generate the alpha. If we're not able to find an alpha despite the hedge, then we did not really find an alpha. It's a little, but so the position level hedging is really a prime differentiator from the portfolio construction process, which is part and parcel of the deal codes. And what this enables us to do through the deal code system is to marry risk management with portfolio construction, one and the same. A lot of other places will have portfolio construction, and then they'll have the risk management teams in the closet somewhere. They're looking at things ex post facto. We are part and parcel where risk management is integrated with the portfolio construction. So that makes a very robust construct, which makes us, frankly, like the house of a casino. Now, I hate to go to the casino because, the odds are against you. The more bets you place in the casino, the greater likelihood you're going to lose. I don't like to lose money. So when I was dragged to the casino, I would put one bet down because that's my best one bet. If I was the house of the casino, if I was like Sheldon Adelson of blessed memory, I would have loved to have gone to the casino. But we've turned Hudson Bay into the casino house by means of our portfolio construct, because each idea is limits loss, each idea is independent from every other idea, and each idea has a slight amount of edge in each idea. Combination of those three factors turn us into the house.
A couple of quick things. First of all, just to clarify, if anybody not familiar, VAR, term mentioned earlier, means value at risk, which is a metric that large financial institutions use to artificially measure risk. And then alpha, just again, we're talking about skill-based return. Just coming back to this deal code system, a couple things. One, if the edge that's created is small, invariably at some point you do need to employ leverage in order to magnify its impact. How does that, and I know you started out using nominal leverage or limited leverage, how has that evolved? Is that still true today? And asked another way, is there any other second order impact of your strategy or challenges that your strategy introduces that we may not be thinking of?
Well, it's an interesting way you articulated leverage. That if you have a small rate of return, you want to lever it up to get a larger rate of return. And that is, in fact, kind of the that's sort of the trick that a lot of investment firms use, is they dial up and dial down the leverage to achieve a targeted rate of return. But as they dial up and dial down that leverage, they're altering the risk profile. And people are focused on how much they'll make, not about the risk profile. We want to maintain a constant risk profile. So to do that, we're looking at how much can you lose in a reasonable worst case scenario. And then based upon how much you can lose, then the next question we'll go to is how much leverage do we feel comfortable putting on? But a lot of firms, in particular guys that came off of bank prop desks, were used to always leveraging to the hilt because they had this low cost capital. And if they could get an excess return, the more leverage you put on, the higher your return. And that ignores risks. So I just think it's an inappropriate way to go about it.
So if you think about risk in a highly precise way, as you do, are there any specific risks that you're most concerned about? Or is it really more about managing the system's ability to isolate the risks? How does this kind of approach translate into how you think about risk management?
Well, every decision at Hudson Bay is done with precision. And the deal code system, by identifying each idea and all its related hedges, enable us to zero in on exactly what's going on, to look at the history of that deal code idea position, how it was sourced, how it was put on, how it was traded, how it was hedged, how it was adjusted, and how it was exited. And that precision with a time-tested team and a market-tested system enables us to really isolate each idea on its own to make the appropriate risk-reward assessment. most other firms are relying too much on quantitative mathematical models, which have a lot of underlying assumptions, usually that there's a normal distribution. In other words, that there's a probability distribution that's like a bell-shaped equal up, equal down, or modify, whatnot. We're looking at precisely that idea of what could happen. And it's that precision that enables us to power through periods of market disturbance. Now, when the markets are placid, it can look like people are risk managing, but it's really a charade. You know, risk management is being able to risk manage through the difficult periods of time. And I think that we're going to start re-entering a more difficult period of time.
So let's dive into that in terms of what you're seeing and your personal outlook for the markets. What sort of opportunities and challenges are you most focused on right now that you're sort of seeing on the horizon?
We're living through momentous times because despite the 2009 printing that got us out of the great financial crisis and the quantitative easing that kept rates down abnormally low, the COVID shock turbocharged everything. The amount of money that we printed dwarfs the amount of money that was for COVID, dwarfs what was printed before. So we've just gone pedal to the metal with abusing monetary policy, not just in the United States, but globally. And we're now starting to see inflation. Modern monetary theory says you can print till there's inflation. Now we've got inflation. So, you know, the market still thinks, because the market's been anchored, the market still thinks that inflation's going back to 2.6 is what inflation expectations predict. And so consequently, the rate curve further out is predicting that inflation is going back down and that rates will stay low. But as we discussed, so much leverage has been built into the system through shadow banking and other type tools that structures are going to break down if longer term rates stay higher. People won't be able to refinance at the same rate. They won't be able to make their debt payments. And so I think this is going to really reshuffle a lot of financial assets. Now, it's possible that Main Street, Street's chugging along, you know, relatively okay, but the financial assets that are backing the economic engine are going to need to be recalibrated based upon the higher rates, for sure. And I don't know when that's going to happen. It's going to happen when inflation expectations, I think, are recalibrated higher. If you look back historically, since 1871, the 10-year long bond has only been below 3% in 2 periods of time. That was during World War II and shortly thereafter, when the US targeted rates, the Fed targeted rates, and post the great financial crisis. And now we've really gone through the Fed's gone through a real shift show of sorts, where, you know, the from opening the punch bowl, now they're pulling back, they're clogging the sink, and that's going to ricochet. You're starting to see it now in commercial real estate, which was partly because of COVID, but also partly because of the financial the borrowing issue. You're going to start seeing that ricochet throughout many aspects of the economy.
And therefore, what does that mean for you guys? In other words, as a result, what things are you looking at differently than you have before? What things are you most excited about? What things are you most concerned about?
Well, we recognized last summer that inflation was not transitory, and at the time that was a bit novel. But we realized that inflation was global. There was food inflation. It was not just from the Russian invasion, but this was going to be more persistent throughout wages throughout the entire world. And so we moved to conservative position, and we're still in a relatively conservative position, because when these things break, it's very hard to adjust. So we're lying in wait. We're set up in distressed and structured products and all types of credit. There will be opportunities in equities as well. The markets, it looks like the markets are up, but I'm sure, as you know, that the S&P 500, for instance, is really powered just by 7 stocks, and the other 493 stocks collectively are actually down. And that's really an amazing, that's an amazing way to look at it. So I think there's going to be tremendous opportunity because people are so anchored and markets are so anchored that things are just going to go back to the way they were for, post 09. And it's just a fallacy. If you look, aside from those periods of time when the Fed targeted rates, the 10-year has averaged 4.5%. And if you exclude those periods of time when the Fed targeted rates, the 10-year long bond was 4.9. And right now we're at 3.6, 3.65. To move from 3.65 to 4.9 is a big change. And I think it's possible to even go beyond that.
So how do you, given what you're seeing, and I think we're all seeing something similar, how does that translate into where you build conviction or how you build conviction around your ideas? And are there specific pockets of opportunity that you are most focused on right now? And what might this be?
Well, we're blessed that we're in a multi-strat framework. So we've got teams across lots of sectors, which enable us to step into places where banks might be afraid to lend. So as bank capital requirements are going up, as banks need to conserve their margin, they're less willing to make loans. Now to extend financing, to buy credit products, to participate along the shadow banking facilities that are set up. In order to participate in that, you have to have a great understanding of the sector, the asset that you're in, of the financing structure, of the capital structure. You need a broad range of abilities in order to bring it all together to comfortably invest the money. And because we're in the multi-strat, we're able to step in wherever there's a dislocation.
And so, again, this may be going back to the previous question you mentioned, and one of the things that you've strived for is for Hudson Bay to do well in various market environments. So,
no, all market environments.
In all market environments. So, again, unless one is net short, how do you actually do that? Like, how do you make more money or money in difficult markets in a way that other hedge funds may not be positioned to do?
Well, for every idea, we hedge the beta to the extent we can identify a beta. The beta might be the market. The beta might be credit. The beta might be interest rates. To the extent we can identify a beta, we will seek to hedge that beta, which means that we will short an ETF, short a stock against it, we'll trade an interest rate future, maybe we'll trade a CDS contract, credit default swap contract, but we seek to hedge the beta, and because we're so precise, because every decision is done with precision, we're able to select the appropriate hedge. That's done by each portfolio manager. We have 27 portfolio managers, and each portfolio manager is well indoctrinated in our portfolio construction system in the deal codes. They're selecting it. We have our risk team that's assisting them and supervising them to make sure that they are selecting the right hedge. And by building position by position, we're only putting on positions that have edge. We're generally not taking a position, the market's going up or market going down. We're looking for something that's going on, usually on the micro, but sometimes on the macro. Usually in the micro, there's some kind of catalyst or change or event that we can better express, and often utilizing as well some kind of optionality type overlay. An option has limited risk, and unlimited reward. And there's also convexity to an option because of that. Because an option can't go below zero, but it can go up to infinity, that means that it's asymmetric. So there's a convexity. And so we try to incorporate convexity in our positions around event catalyst or change, and that enables us then to make money in all market environments.
And you mentioned your 26 portfolio managers. Is there something unique about how you incentivize your portfolio managers that might be different from other firms? Is there something fundamentally different from a cultural or a philosophical point of view?
Well, we're very focused on environment. We don't call it culture, we call it environment. We pay our portfolio managers generally based upon a percentage of their earnings, but they could also become partners. However, they're working within the environment of the firm, which is marked by three characteristics. The first is, and we codified this so that everyone knows, it's like on everyone's screen, we refer to it all the time. A lot of times people come up with these value statements, but they're kind of run-on statements and they get lost. So just three things. The first is we promote independent thinking. We want people to question the experts. The second is we foster collaboration. We seek to enable people to learn from each other. And the third is all this is done within an atmosphere of respect for the individual. So even if we have to fire someone or we disagree with someone, we always do it in an atmosphere of respect. So we promote independent thinking, we foster collaboration, and we respect the individual. And for a portfolio manager, frankly, anyone, any of our colleagues, they can progress professionally better by being able to collaborate with other people. So people have some people learn better on their own. Some people learn better from others, but it's a spectrum.
Right.
And like when I come home and I see the kids with tutors, it drives me nuts because I want the kids to struggle on their own to learn it. But I do recognize that for some, they can learn quicker by working with other people. So every individual, every human being has a different aspect on that spectrum, but it's by providing that environment that I think enables us to attract people who enjoy being creative, independent, but still learning from each other in a professional environment that promotes their career.
And I mean, you mentioned collaborating with people and sort of in your strategy, which has so much technicality to it. I'm actually, again, it might be a little bit of a non sequitur, but I'm curious to what extent either disruptive technologies or AI has a role to play in at least helping you increase that precision. And maybe a framework to think about is if you were restarting your firm today, what might you do differently, or how might you structure it differently, given what you know about the technological landscape?
This is a big question. We're asked this virtually every day about the generative AI. And I don't believe generative AI replaces decision-making. What it does is it enables us to acquire information more quickly. And we're in the process of acclimating that more into our organization. So I think to a certain extent, it can replace or augment the junior analyst, but I don't think it in any way replaces the senior decision maker at all. It's another tool that the senior decision maker can use to make better judgments. Now, I understand with coding, there's help with coding if you want to get on the business side, but there's been tools out there for coding before. It also does help with generation of some prose, but these things are all, I think, augmentation. They don't replace the human decision making. Ultimately, our business as a multi-strategy hedge fund is a people business. And we have to create an environment that people want to work in. And we want to harness the human talent within disciplined frameworks. So generative AI doesn't help to make the decisions, except it provides more information for that human talent.
Right.
And so I'll give you a quick example for me personally. When SVB went down, And there were worries about First Republic and Signature Bank. And at the time, the Fed and others were saying, this is just isolated to those three banking institutions. This is not a broader impact across the entire industry. But I knew that rates up means, the value of your assets go down. Now, I had thought that the banks hedged the rate exposure. To me, it's crazy that, when bonds are like 1.5%, you don't hedge that.
Right.
It's insane.
Yeah.
Like I was really floored. But when it was clear that these banks had not hedged that rate exposure, I said, wow, what's happening with the broader industry? So I went to ChatGPT and I said, what Fed report reports the AOCI? AOCI is alternative other comprehensive income, where the banks actually say if they held mark to market as opposed to moving the bonds to held to maturity. As you know, they moved to held to maturity so they don't have to market.
Yep.
But available for sale had to be marked. So all the banks last year moved to held to maturity so they could avoid the markdown. So I assumed they had to report to the Fed what that markdown was. So I said, what report, ChatGPT, what report? And at the time, the sell side, no one knew, I could have gone through the Fed. It came back immediately, go to this report. Now, ChatGPT was wrong. It was not the report, but enabled me to navigate. So in 15 minutes, I was able to find the actual Fed report. And I saw the banking industry had lost 20% of its equity capital just based upon the interest rate move on marketable securities, which is pretty astounding. And I was flabbergasted because the sell side didn't know, no one was talking, there was still this view that it's transitory. That's not including loans, so loans, credit, whatever. Wow. This is just marketable securities, and it's in there in the Fed report, So I couldn't have found that. I would have found it. I would have put an analyst on it. It would have taken a day or two to come back, but I was able to find it in 15 minutes because of ChatGPT.
Yeah, interesting. There's a couple of questions that have come in the Q&A. I'll throw one of them and then we'll carry on. Just one of the questions has been around the growth of the firm of Hudson Bay has grown quite a bit over the last few years. How do you think about the right size of the asset base? How do you think about, the right size of capital and performance? And how do you think about that corresponding to, being able to tackle the opportunities that you want to tackle and not having any access above that?
Well, the capital has enabled us to build capabilities. The ability to deploy is based on two things. One is market environment, and the other is capabilities. And we've taken in more assets because we think we're into this extraordinary market environment, which fits right in with our competencies in terms of portfolio construction. And we built the capabilities to deploy that money. Now, everything's timing, and you're not going to get timing precise, but you will know when you're closer to that time. And it's still early. And so we're still waiting for inflation expectations to recalibrate before that happens. Now, I could be wrong. Inflation expectations might go down. If that's the case, though, then I would think we're in deep recession. If we're in deep recession, then there will also be tremendous opportunities. So I don't see any way that we won't have tremendous opportunities. Either inflation up, rates up, which will cause financing structures to break, or we'll go into deep recession, and that will also provide capabilities. But we feel very comfortable. We did go into a soft close at $20 billion because we want to make sure that we do deploy appropriately, and we're now launching a special opportunity fund to take advantage when the dislocation occurs. But we feel very comfortable where we are, and the added capital has enabled us to build the capabilities. So we hired the head of distress from Morgan Stanley and built a whole team in structured products. We hired Bill from CQS and built a whole team around that. And we're constantly, we don't need to hire anyone, but we think that credit is going to be the place to be.
Interesting. And I mean, obviously, you've been more right than wrong, and you've kind of been able to produce extraordinary returns over a number of market cycles. And obviously, we're familiar with that as investors in Hudson Bay. I guess curious what you think has been along the way. I'm sure there's been enlightening mistakes, and I would love to hear what you've perceived to be as the most transformative or the most enlightening of those mistakes, and how they've shaped either you or the firm or your strategy going forward.
Biggest mistake we made at Hudson Bay was going into trading financial transmission rights. That was back in 2007. And we thought that we hired the right guy. We thought that it was a diversified strategy. And then something very unusual happened where a transformer on the network went down and things went limit up, and it hadn't happened before. But from that, I realized that, and by the way, of the 13 market participants, it looked like only 2 got it right out of the 13. But if we can't be one of the 2, we shouldn't be in that business. And so when we expand, we do expand our capabilities and our competencies, but we always do it into adjacencies. And financial transmission rights was not an adjacency. And even though we thought we had the right person and they had a pedigree and everything, we need to be able to independently evaluate the risk reward when we go into something. So it was a great lesson for us, which fortunately we had early on. And so as we expand very slowly, very cautiously, and we make sure that we can understand the risk reward dynamics.
Right. Interesting. And, I mean, you've actually shared a little bit of your views on, where we are in this cycle. But I know that you've been very involved, in a broader sort of geopolitical context with USAID and obviously the intelligence agency and so on, and perhaps other government agencies. Just when you look at some of the other either macroeconomic or socioeconomic themes and shifts, do any of those impact your strategy? And if so, which ones? Whether it's geopolitical, socioeconomic, et cetera. And how do you think about that?
I've been very fortunate to have a lot of entrees into the policymaking community in the United States and elsewhere. And we don't make our money off of the macro generally. We're not macro traders, but the macro environment does color our deployment overall. And right now, I think that there really is this momentous change where you have, on a geopolitical level, you have governments of like nature, generally democracies, social republics, aligning against authoritarian governments. So there was a period of time, I'm from Michigan, and China emaciated the Midwest of the United States. They took the manufacturing jobs away and really hurt the Midwest a lot, the cheap labor being outsourced. You're seeing a reversal of that now, that China is being viewed at best as an economic competitor, and China is coming closer to Russia and Iran. And the Saudis, even though they're with us, there is a certain allure given some people in Washington's distaste for the kingdom. They're kind of between these. And so this causes a realignment of trade flows, a realignment of capital flows. I think there's going to be an onsourcing of jobs back into the Midwest, which I think should spark further inflation as people hire more, as people produce more in the United States, with a reluctance to continue to invest in China. And I think that this is going to be another major driver of inflation. We usually think that inflation is bad, and inflation at a certain level is bad, but it's certainly going to push us, I think, more higher by necessity. And I think that the geopolitics is pushing us that way.
Which would it suggests that rates are not going lower anytime soon, even though the market on some level is projecting that.
Exactly.
Yeah. And is there anything in particular that keeps you up at night?
No.
All right, fantastic. So maybe, I know we're sort of running up against time. Maybe we could end with one or two more questions, which is, well, first of all, I'm curious about the best piece of advice that or wisdom that anyone has ever imparted on you. And then maybe I'll ask you to do the same.
The best piece of advice. Well, it's hard to go with best, but if you want to put it in terms of organization, my dear friend Dave Petraeus taught me that for an organization, you need to define the big picture. And I highlighted from Bain and Company that I saw the problems. I didn't necessarily see how to solve the problems. And from Dave, I learned that when you're running an organization, you need to really define the big picture and with metrics of accountability, and then you can have a collective work together. And I find that that's super important, because inevitably in any organization, there will be conflicts, well-meaning conflicts. But if everyone can relate back to the big picture, then those conflicts often can be much more easily resolved.
And so that's at the organizational level. And that's, is there, since you've effectively run your own family office, any words of advice that you might offer to other either family offices, single family offices, or ultra affluent families, which is the preponderance of people on this call?
I don't know if I'm qualified to offer, moral advice to people. But I think that in terms of a business owner, as when I started the business, and I remember each time I made a change, I've only made a change slightly. I went to the floor, I went off the floor, and then started Hudson Bay. And every time, I think the worry when you start something new is how do you push on when you make a mistake? And you have to develop a certain confidence that even if you make a mistake, you'll be successful the next day. And that takes a maturity, that takes experience, but to be able to power on and know that next day things will go better. And I think that grit or fortitude, which unfortunately I think a lot of times people don't have so much, like sometimes when people have it too easy, they don't develop that grit or fortitude. I made my son work with the landscaper for a summer. Now, I didn't realize that all his coworkers were Mexican convicts, but he learned a lot. He learned that, not everyone grows up with privilege. You got to work for a living. You need fortitude. He also worked the same summer in the US Senate. And my son wrote to me what he learned in the Senate and what he learned from the landscaper. And I reviewed it with the senator. And from the Senate, he learned difficulty of passing complex legislation. From the landscaper, he learned don't yell at people and get them to do things. Always use auto bill paying. He had like a whole list of 10 things. And it was a much better life experience to work with. And I think it engendered with him a certain amount of grit, which I think is important for anyone who's starting a business.
First of all, what a great place to end it, Sander. That was fabulous. And speaking of grit, I mean, you were kind enough to join us, even though you, as you mentioned to me earlier, you have COVID today.
I'm sorry, I'm a little off. Yes.
Yeah, you're not off. That was fantastic. And I really can't thank you enough for joining us and sharing your insights and being so generous with your time. We really do appreciate it and hope we can do it again soon. Thank you.
All right. Thanks, Mo. That was fun.